Welcome to this video on futures-specific properties. Rather than reading and memorizing the lengthy specifications documents for each futures market, all you really need to know is a set of standard properties. In this section we'll look closer at these properties and how they work the same way for practically all futures markets. This is when things move from the theoretical to the practical. These are properties that you need to know about every market you want to trade, and by knowing them you can effectively treat all futures markets in the world the same way. For every futures market you want to trade, you need to know these properties. Let's go over them, one by one. Root symbol. Every futures market has a symbol of usually 2 or 3 letters designating the market. For example, the COMEX gold market has the root symbol GC and the crude oil market CL. This property is specific to the market, not to the individual contract. Month. When you buy a contract such as gold, you buy a specific delivery. You don't just buy gold, you buy December 2021 gold, for instance. To signify the month in question, a single letter is used according to the delivery code standard for futures. These month letters are the same for all futures markets and something you should simply memorize. Ticker. Every futures contract has a ticker consisting of the root symbol, month letter, and a number for the year. The year number is usually 1 or 2 letters depending on the data provider. Putting it all together, a ticker may, as an example, be GCM2. With such a code using only a single year digit, the decade is implied, and this would refer to COMEX gold June 2022. Expiry date. Every futures contract has a final date at which time it ceases to exist. This is the last day in the life of this particular futures contract, and for many markets this is the date you need to be out by. But be careful here. For commodity futures you need to be out before the first notice date. That's all for this video. In the upcoming video you will learn about the remaining properties.
Welcome to the second video on futures-specific properties. In the previous video you learnt about the futures-specific properties, like root symbol, month, ticker and expiry date. Let's go over the remaining ones. First notice date. Most commodity futures are deliverable as of the first notice date, meaning that after this point in time you may be called upon to make or take delivery. As a speculator, this is something that you do not want to happen. A truck full of live cows outside your office can ruin anyone's day, but this is in reality not a risk for regular futures traders. Unless you have signed some special documents with your bank, you will not be allowed to keep a position past this date, and they will shut you down. Still, you do need to be aware of the first notice date and close your position before this, not to risk the bank or broker doing it for you. Margin. When you open a position in a futures contract, long or short, you need to have sufficient margin on your account. You don't pay up the full value of the contract, as you would do with stocks for instance, but a certain margin is required to ensure that you can make good on your obligations. Always make sure that you have enough money on your account to cover not only the margin but also an adverse move. You need to maintain a certain minimum margin on your account at all times, or you risk having your position shut down for you. Execution terminology. In the futures world, participants tend to use slightly different terminology than with stocks or currencies. In the case of placing trades, the reason for this is clarity, to avoid misunderstandings. Being long means to hold a net positive number of contracts, and thereby speculating on the price moving up. Being short would be the opposite, holding a negative amount of contracts and speculating on a decline. So far the terminology is the same as with other asset classes. But when you place a trade with the purpose of going long futures, you say that you are buying to open. When you later want to close that position, you are selling to close. The equivalent goes for short positions where you are selling to open and buying to close. That's all for this video. In the upcoming unit you will continue to learn about futures-specific properties.
Welcome to this video on futures data. If you are used to trading stocks, you are familiar with the usual set of fields for historical data. Normally we would then be dealing with the fields open, high, low, close, and volume along with the date or timestamp for each row. In the futures world, we have all these fields. Additionally, we also have a new and quite important field called open interest. To explain this field, first keep in mind that in the futures world, we are always trading a specific delivery. You cannot simply take a position in crude oil. You need to pick a specific delivery of the crude oil, such as the December 2021 crude oil contract for instance. This brings us to the concept of a futures chain. The chain is a list of all the currently traded deliveries of a futures market. This shows all the available deliveries that you could choose to trade, but bear in mind that many of these are highly illiquid and are barely traded by anyone. At any given time, there will be one delivery for each market that has the lion's share of the trading activity. The trading activity will move from one month to the next, over time. The futures chain will give you a quick overview of how the situation looks at the moment. In the futures chain for crude oil, you see that there are quite a few deliveries available to trade. But we can also quickly see that only a handful have enough trading volume to be of any potential interest. Each row in the chain shows data for one specific delivery, where the first row here is for February 2021. We see current data, such as last traded price, net change, bid and ask, and such. But for now, skip to the last two columns. First we have the historical volume, which is the amount of contracts that changed hands during the previous business day. This is akin to the volume field you have seen in stocks. The last column of open interest is specific to derivatives, such as futures. The open interest tells you how many active contracts there are at a given time, for a specific delivery. This is best understood by a simple example. At the time that the screenshot of the futures chain was taken, the open interest for the February 2021 crude oil was 369,542. If you now pull the trigger and buy one of those contracts, then this number would immediately go up to 369,543. An hour later, you decide to take your profit on this trade and you sell to close your position. At that point, the open interest will decrease by 1. When someone buys a contract, that means that someone else went short that contract. There are two sides to every transaction, where someone is long, and someone is short. Each such pair counts as one contract in the open interest ledger. The key difference between volume and open interest from a practical point of view is that open interest will go down as the contract nears expiry, and traders start shifting out of that delivery and move into the next delivery. What you can see in the chain is that the volume in the last trading day was overwhelmingly high in one of the deliveries, and quite low in all the rest. The open interest was by far highest in that same delivery, but there was also quite high interest in the next few deliveries out. This means that for futures, we have two fields to keep track of when we analyze trading activity. Not only the volume matters, but also the open interest. For most types of trading strategies, you would want to be in the most liquid contract at all times and roll from one month to another along with everyone else. In this course, you will look at strategies that do just that, and also at strategies which deliberately do something different, to exploit the price differences between the different deliveries. That's all for this unit. In the upcoming video, you will learn more about the issue of limited lifespan.
Welcome to this video on the issue of limited lifespan of futures. Both the challenges and opportunities with futures data can be summarized in two words: limited lifespan. While markets like stocks and spot currencies can, at least in theory, live forever, a futures contract has a very limited and predictable lifespan. During its lifetime, there is usually only a brief period when it has enough liquidity to be relevant. As we saw in the previous section, you don't just buy gold futures, you buy something specific, such as March 2021 gold. That contract would cease to exist by the end of said month. The first and most obvious implication on this is that we simply lack long-term time series. We have thousands and thousands of individual futures contracts, most of which only have a month or so of relevant price action, when the trading activity was high enough for them to matter. Now just imagine a simple task of calculating a 200-day moving average. It's suddenly not so simple anymore. Another problem is how to go about your trading if you simply want to buy and hold gold futures for a few years. It may seem as if the simple solution is to just roll from month to month, meaning that you exit the contract about to expire and enter the next one. That may be the closest proxy, but you need to be aware of what it really means. Consider what's going on in the image on screen. Each chart pane shows one delivery of crude oil, where the black line is the last traded price and the gray area represents open interest. The dates on the x-axis are the same across all 5 panes. What you see here is how the trading activity keeps moving from delivery to delivery. In July of 2002, the open interest was shooting up in the 2002 October delivery. A month later, traders start to exit this delivery in favor of the November equivalent, and this same rolling activity keeps occurring every month. In the upcoming unit, you will continue to learn about the issue of limited lifespan of futures.
Welcome to this video on the price difference in futures contracts. In the previous video unit, you saw that if you want to stay long gold, for instance, you would buy the most active contract. That is the one with the highest open interest. And then exit your position and roll into the next contract when the open interest moves. But if you would now like to calculate a 200-day moving average, which of these series would you use? The problem is that each of them are only relevant for about a month. If you look at the graphs, for instance, you see that it has multiple years of history. But the issue is that for most of this time, there was hardly any trading activity at all, and therefore the price is neither reliable nor relevant. Unfortunately, you cannot simply stitch together a time series by just cutting and pasting, putting snippets of the different contracts after each other. The reason for this is that they are not the same. If you make one series out of them, without adjustments, you are mixing apples and pears. The December 2021 gold is not the same as the March 2022 gold. They will be traded at different prices, and there is a good reason for this. Earlier we looked at a futures chain. Let's have a look at such a chain again, but this time we'll focus on the price column on the 28th of December, 2020. The chain shown here is for gold futures. If you look closer at the price column, you'll see that the prices are not the same. At the exact same point in time, the January gold will trade at a different price than the February gold. Perhaps you would think that this difference doesn't matter, but nothing could be further from the truth. This is one of the most important things to understand about futures, and without grasping this concept, you would be ill-advised to enter the futures trading arena. In this image, the most active delivery is February 2021. You can easily spot this by seeing that this is the one with both the highest volume and the highest open interest. Almost all the trading activity in gold is currently done in this particular delivery. The February 2021 gold shows a last traded price of 1,882.2, while the April contract is at 1,886.3. A common misunderstanding is that this difference reflects the market's anticipation of the direction of the gold price. That is not the case at all. This price difference reflects the cost of carry, which in itself has a few different factors that may influence it. To make it simple, you can view this as a hedging cost. Think about what the difference is in having a physical gold delivery in February or in April. Even if you have no interest in ever handling physical gold, it is a thought experiment that may help you understand these price differences. There is a 2-month difference in the timing. So how do you hedge the price risk of 1-month gold? First, you would need to buy the actual, physical gold. That takes cash, and cash isn't free. This means that interest rates will play a part in terms of financing the purchase. Then you need to store it somewhere for a month, and that's not free either. This goes some way to explaining the price difference between deliveries. There are more factors, such as seasonal demands, but as a speculator you normally do not need to analyze the reasons for the differences. It's enough that you understand that there will be price differences, and that these can both cause a problem and open opportunities. In the upcoming unit, you will learn about the continuation of futures. Welcome to this video on the background of trend following techniques. Trend following is arguably the most ubiquitous futures strategy. The principles behind this type of strategy have been well known and documented for decades. These principles have shown very strong empirical results since it was first formalized in the 1980s. Today there are an estimated $500 billion managed through trend-following futures strategies, and it has grown into a large global industry. While it is likely that many traders around the world developed similar strategies independently, the origin of trend following is often ascribed to early commodity traders in Chicago. Safe to say it was considered a fringe strategy for quite some time, traded at very high risk levels by daring traders who ended up showing spectacular returns. There are plenty of true stories about such early traders, who achieved amazing results and built wealth rapidly. However, you should always keep in mind the concept of survivorship bias. With a group of traders taking very high risks, most of them are likely to wipe out and lose their money, while a few will go on to make a large profit. In the end, you only hear about the ones that succeeded. If you search around on the internet, you are sure to find a description of the rules that these early traders used, either for free or by those who sell such rules. It cannot be overstated that you should treat such rules with caution, like you would treat a crate full of dynamite. Despite these rules having worked in the 1980s for some of these traders, they were based on taking an extreme risk, and they were deployed at the time when such an approach to risk happened to work. Luckily, as the field has matured, so has the sophistication of the methods and the research into what actually makes the approach work. In this course, we will look at the principles behind trend following, the various components of such strategies, and the reasons for it to have worked so well over the past decades. Like all spheres of life, there is no magic bullet for trading. Bear in mind that what we are doing here in this course is to teach you the concept and methods required. We will build up a trend model piece by piece, as a teaching tool. What we are not doing is to attempt to provide a super trading model, or the best possible way to trade, if there is such a thing. That's all for this unit. In the upcoming video, you will learn the principles of trend following.
Welcome to this video on principles of trend following. The idea behind trend following is really quite simple, and you will find that this is the case with most robust trading methods. It's always desirable to have a simple and easily defined concept that you are aiming to trade and to know what market phenomenon you're planning to exploit. What you would like is for the strategy you employ to be easily explainable. If you struggle to explain it, odds are that something is not right. The opposite, which you should try to avoid, is to combine indicators and methods until your backtest shows positive results. If you don't know what you're trading and why, it's highly likely that any backtest result is simply the result of chance or over-optimization, and that it lacks predictive value. You may have overfitted the variables or simply thrown indicators at the wall until something stuck. This is not how you develop robust trading models. The fact that the idea behind trend following is simple does not, of course, mean that implementation is easy or that it's easy to make money. You will still have to work for your money. The basis of trend following is based on the empirical observation that prices often continue to move in the same direction for a sustained period of time. The goal of the strategy is to capture the bulk of these moves, but never to buy at the bottom or sell at the top. What we want to do is to wait for the market to start moving in one direction, up or down, and then jump on the bandwagon and stay with the price move for as long as it lasts. An important part to understand about trend following is that you will never enter or exit at the best prices. You will always get in too late and get out too late. That's just how the strategy works. You have to wait until the price takes off and enter after it's already moved enough to qualify as a trend. Once the trend is over, we will not know that until the price starts moving against us. That means that we will always give up part of our profits as we wait for the price to move against us before exiting. Another interesting thing to keep in mind is that most trend-following trades end up losing money. Even for successful and profitable trend-following models, usually between 60% and 70% of all trades entered will fail. That is just the cost of doing business in the trend-following space, and as long as you end up making money, overall it shouldn't matter how many trades fail. When done right, the failed trades should have quite small losses, and there should be some outsized winning trades that make up for them and more. The point of trend following is to guarantee participation in all trends. The only way to have such a guarantee is to enter every possible trend breakout, never missing a single one. A few of them, a small percentage, will be the big winners. Those will continue to trend for a long time and create a high return, and they are absolutely necessary to pay for all the small failed trades. The only way we can be sure that we'll participate in these big winning trends is to never miss a trade and always enter into every single trend breakout. A good trend following model has a slight statistical advantage with a slight net expected value. Imagine, as an example, if you could play a casino game costing $1 where you have a 70% probability of losing $10, 20% probability of ±0, and a 10% chance of gaining $100. How many times would you play the game? The answer should be as many times as they would let you. If you play such a game once, anything could happen. 10 times, anything could happen. But if you play it 1,000 times, you're likely to have net gains of $2,000. That's all for this video. In the upcoming video unit, you will learn about trend following entries. Welcome to this video on the financial risk primer. The concept of financial risk is perhaps the most essential to understand for any trader. It is a topic far too often misunderstood, and something that you should not gloss over. How to measure and view risk in the financial markets is absolutely critical to understanding any trading approach. Financial risk is about potential value variation per unit of time. That sentence is actually important enough to repeat again. Financial risk is about potential value variation per unit of time. Before digging into exactly what that means for finance in general, and our trading model in particular, let's look at the common misconceptions around risk. The worst offender in the category of risk misconceptions is the idea of risk per trade. This idea is based on risking a certain amount of dollars or percent per trade that you enter. For instance, take an investor with an account worth $100,000. He wants to buy shares in Initech, which is trading at $20, and he wants to risk 1% of his account on this trade. He thinks that a stop-loss point at $18 makes sense, so how many shares should he buy? He decided to risk 1% of his $100,000 account, which would be $1,000. There's $2 between 20 and 18, so if he buys 500 shares of Initech, and his stop-loss point is hit, he would then lose that amount. So he should buy 500 shares. But the problem here is that this concept has nothing to do with risk. The risk per trade concept comes from gambling, not finance. And you really do not want to use gambling methods in finance. A better way to measure risk could be by studying its volatility, which will be covered in the next unit.
Welcome to this video on measuring financial risk using volatility. Without a time component, it is not a risk measurement. There is a difference in losing 1% in a minute or in a year. Just like there's a difference in making a 10% gain in a week or in a decade. Without the time component, it's simply irrelevant. A more rational way of looking at financial risk involves using volatility information. This means that we consider how much something tends to move up or down in a certain time period. The concept of volatility is important for all of finance, but when it comes to futures trading, it becomes even more crucial. The reason for this is that the various futures markets tend to show rather extreme differences in volatility, and without taking that into account, these futures trading models do not make much sense. For the palladium market as an example, daily moves of 2 or 3% up and down are common, and shouldn't come as a surprise to anyone. Those are simply normal daily variations. But in a market, such as the 10-year Treasury, a daily move of 0.5% would be considered extreme. Now imagine that you have two positions, one in palladium, and one in the US 10Y, both for the same notional value of $500,000. The same dollar amount is in both positions, but in terms of risk practically everything is in the palladium position. The tiny moves in the treasury market wouldn't really matter compared to the huge swings in palladium. It's important to understand that the distance to your stop-loss point is absolutely irrelevant to this view of risk. It is the potential for daily variation that matters. What would you need to do, then, if you would like to take approximately the same amount of risk on these two markets? You would need to take a relatively small position in palladium, and a relatively large position in the US 10Y. But how small and how large? That's where volatility calculations come into play. The most common way of measuring volatility is to use standard deviation of daily changes, either percentage changes or dollar changes, depending on what you plan to use the resulting calculation for. In the upcoming unit, you will learn how to calculate position allocation to palladium and treasury using a volatility-weighted approach. Welcome to this video on position allocation. There is a good reason why we took a little break from the trend-following rules to explain the basics of financial risk. A grounding in that area is absolutely necessary to understand how to think about position allocation. For most trading models, you really don't have any reason to assume that one position has a better chance than another. Each position, or bet if you like, can only be assumed to have an equal probability of success or failure. Given that way of looking at your positions, it makes sense to allocate equally to each position. But equal what? As you have seen in the previous section on risk, it wouldn't make sense to allocate an equal dollar amount. As we saw there, if you have a portfolio that has $1 million worth of palladium and $1 million worth of the US 10-year treasury, then this portfolio would be driven almost entirely by the more volatile palladium position. For the same reason, it wouldn't make any sense to buy the same number of contracts for each market. Each palladium contract usually varies in value by over $4,000 per day, while the treasury contract only changes value by around $300. The solution is to attempt to give each position an equal chance to contribute to the portfolio's daily profit or loss. That is, we will allocate more to the slow-moving markets and less to the fast-moving markets, and we will use the volatility calculations to decide just how large each position should be. Take a portfolio of a total value of $5 million. Now we want to buy two positions, one in palladium and one in the US 10-year treasury. We want the positions to have an equal chance to make a dent in the portfolio, so we'll use the volatility parity approach. First, we need to decide just how much each position should impact the portfolio on an average day. This is a rather arbitrary value and will reflect your risk preferences. In this example, we will set 0.5% as a target. That is, we want each position to move the portfolio by 0.5% each day, on average. We'll call this number, the 0.5%, the risk factor. 0.5% of 5 million is 25,000. We will see in the upcoming notebook that the palladium market moves by about $4,670 per day, and the treasury contract by about $289. Dividing the target position impact by the impact per contract and rounding down, we get the number of contracts. Thus, we arrive at the decision to trade 5 contracts of palladium and 86 contracts of the treasury contract. This will result in our $5 million portfolio holding $1.2 million worth of palladium and $12 million of the US 10-year treasury. If you come from the equity world, this may surprise or even shock you, but there is nothing odd about this. Not in the futures world. First, remember that we are not paying up front in cash, as you do with stocks. You only need a small amount of your position's notional value as margin. In theory, you can take on quite extreme exposure. When you deal with cash markets, like stocks, you are very much limited by the amount of capital available. While you can borrow to leverage up stocks, that is very expensive and rarely pays off. In the futures space, leverage is very cheap. But what you really should take away from this calculation example is that your notional dollar exposure does not matter. It is not a very relevant measurement. What should concern you is your actual risk exposure, not the notional value. As we have seen in this simple example, $1 million of palladium is about 10 times more risky than $1 million of US 10-year treasury. The only thing that should concern you is the risk you have on, not how many dollars of face value exposure this equates to. This is the concept we will use for position allocation in this course. That's all for this video. In the upcoming unit, you will learn about trend following stops.